All right, I'm going to give it a few more minutes, you guys, and then we'll go ahead and start.
Hi, Maritza.
Hi, how are you?
I'm doing good. I'm gonna be driving. My kids got really sick and some of them are running late to school and all that. But yesterday I got pulled over because I don't have a place to put my phone down at in the car unless it's like on my lap. So I'm just gonna have the camera off until I get back.
Sounds good. Of
Okay. Thanks for understanding.
course.
Let me get this. Oops, not that.
Okay. So let's go ahead and start, you guys. Happy Friday to everyone. Welcome to the Friday Advanced Markets Training. And today we're going to have a guest speaker, trainer, all of the above. He doesn't really need an introduction because he's, well known for this, for whole life. And he's joining us from Foresters today, and he's going to talk about their whole life product, specifically how to structure it. And if you guys have any questions, please put them on the chat or wait till the very end. Okay. All right. And without further ado, Mr. Bruce, the floor is yours.
Great, thanks, Maritza. And as I said, happy Friday, long weekend as we approach it. I will share my screen, get this thing going. Come on. All right. So we're going to talk really about infinite banking. Infinite banking is just a sales concept. What you're really wanting to do is you're going to utilize cash value, cash accumulation inside of a life insurance policy or certificate. When you think about it, whether it's retirement planning, college funding, banking on yourself, debt-free life, anything that you are going to utilize the opportunity of a bank or of the financial funds inside of a life insurance that's been really overfunded. It's the same concept. Nelson Nash really created this concept back in the 90s. And, more disciples have taken it and just adapted to whatever they want to do. But the concept itself is fundamentally the same across all of these platforms. So you're really having the opportunity, and it's really the last financial tool within life insurance. Also, it gives tax deferred cash value growth and then the tax favorable opportunity when you're taking money out and using it for whatever you want to do. Some people will use a index UL or a universal life product in this. I typically will go forward and say I prefer using a whole life, especially a participating whole life, because it gives you more opportunities, more benefits. I was actually at an IUL training, and the speaker was talking about how they cannot predict the future in using universal life, where on the whole life side, we can predict the future because everything is really guaranteed. And especially when you're working with people's money and want to set up such a specialized plan for this, working with a product that offers the guarantees is of the utmost of importance. So why would you use the Forrester's Advantage Plus 2 product when you're building this? Well, first off, permanent life insurance protection to age 121. Yes, you're going to pay to 100, and then it's paid up and it fully endows at age 121. As I mentioned, it has all the guarantees: guaranteed death benefit, guaranteed premiums, guaranteed cash values. It is a participating whole life. So therefore, there is a potential for dividends. Now, dividends are not guaranteed, but as you know, at Forrester's, we have a very healthy track record of paying out over 60 years. And in fact, over the last 20 years, our average has been over 6%. The last 2 years, it's been at 5.8%. The Advantage Plus 2 is a non-direct recognition product. This is the utmost of importance. Reason being is that there's direct recognition and non-direct recognition. So let's put it into action. So let's say you have two carriers, one with direct recognition, one with non-direct recognition. If you had, let's say, a cash value of 20,000, you took out 6,000, you now have 14,000 left. When it comes time to pay the dividends, they would look, in a direct recognition standpoint, they would look at that account as having whatever's in there, so the 14,000, and they would pay the dividends on the 14,000. That's what they would credit it on. Flip side, non-direct recognition looks at the full amount, even with any loans or withdrawals. So therefore, it would look at the amount being 20,000 and would credit the cash value being on with the dividends on that full amount of $20,000. So therefore, that's why non-direct recognition is so important. And it is a great sales tool to talk, because there are products out there, there are participating whole life products out there that offer direct recognition. And so therefore, you have an advantage with a non-direct recognition product. As I mentioned, tax deferred cash value, tax advantage distributions. We have an accelerated underwriting opportunity. So the best way to utilize this product will be the full underwriting. So therefore, you can use the paid up additions rider. And in using that, that's what really makes it hum, because that's what's building up the cash value. We also have the accelerated underwriting, which will allow you to do really fluidless, so you don't have to go through all the blood, the urine, and paramed that based on, looking at their health, we may proceed without the full underwriting that would be needed in these cases. 2 premium payment options: either they're going to pay to 100 or a 20-year pay. Typically, when we're doing these, we are doing a pay to 100. We are stretching it out, and so therefore it allows us to really build this product that is the most beneficial to the client, to the insured. You can do it as a non-med or fully underwritten. Again, we're going to do most of our plans fully underwritten, because the non-med does not have the flexible paid up additions rider. It only has a single premium, and we're not going to really utilize that single payment. We're really utilizing the opportunity to continue to add funds in overfunding the life insurance to build up the cash value. At Forrester's, the Advantage Plus 2 has a lot of benefits and features. There's a charity benefit provision. There's the living benefits, or the accelerated death benefit rider. There's also additional riders for added flexibility and to really customize the opportunity. For the most part, we're not really going to utilize many of the riders that we will use will be the paid up additions. And then of course they get the Foresters member benefits. That's what really makes this special, is the opportunity to come with Foresters as a fraternal organization that really cares about our members and doing good to the community. So when we take a look at the non-med versus the med, on the non-med, really three underwriting classes. It's going to be the juveniles, and then we have tobacco and non-tobacco. Tobacco for this product is any nicotine product used within the last 12 months. Age, it is age nearest. So therefore, it is that plus and minus 6 months around their birth date that they are that age. Again, you can see the non-med goes up to age 75. Minimum face amount is $25,000 across the board. Somebody up to age 55 can have $400,000. And when I talk about non-med, it's simplified issue. It is just that. No blood, no urine, no APS, no paramed. Just take the application. We will run an MIB, a prescription check, an ID verification, and we're going to issue a decision. Standard rates to table 4 underwriting, so they can have less than standard health in order to qualify for this. But again, we typically do not worry about the non-med product because it doesn't allow for the flexible premium paid up additions riders. So we use the fully underwritten product. Again, there are a number of rating classes for your client. Yes, you can do it for a juvenile. We do have certain standards on how much funding they can have on a child. Again, still age nearest. There are 2 bands. $500,000 will be the differential there. As you can see, you can write a fully underwritten up to age 85 on a client. Between 0 to 75 at 50,000 is the minimum face amount. Again, 2 payment options, the dividend options. The default is paid up additions, and typically we don't even mess with that. We will keep it at the paid up additions because the dividends, by utilizing the paid up additions, means more money goes into the cash value, which really builds up the product that they want. Loans. Now, as I mentioned, it's non-direct recognition. So therefore, when they take out money from their cash value, that when it comes time to pay the dividends are not guaranteed, but when it comes time, if there is a dividend, we are going to use the full cash value in calculating the dividends, no matter if there is money taken out of the cash value. Interest rate currently, it will be set annually. It can be adjusted, is 4.5%. So remember when I talked about the dividends, we have a pretty good track record. The last 20 years, our average has been over 6%. The last 2 years at 5.8% on a dividend. And yet the interest rate is only 4.5%. Yes, you have to pay the money back, but the most important thing is you're paying yourself back. So therefore, you're actually increasing the value by paying it back and utilizing it as such. Riders, there's a couple of complimentary riders as long as it is available in the resident state. And then there are some optional riders. Again, we're really not going to talk about a lot of the optional riders except for paid up additions. There's a single pay and the flexible pay. We'll get into that. Then there's also the 10 and 20-year term rider. We typically will utilize a term rider on these scenarios. Reason being because by using the term rider, it's going to allow us to increase the face amount, limit the amount of premium because it is a term product, not a whole life. And so therefore it's cheaper in cost, and therefore we can put more funds into the cash value. So again, by utilizing a term rider, it's going to allow us to increase the face amount, limit the premium, and put more money into the cash value. Paid up additions just provides the owner the opportunity to build up a bank account. Really, it's to have that cash value or cash accumulation. Now, there are no premiums associated, but there is a 6% expense charge that is a front end charge. So therefore, any funds that they are putting into the paid up additions at the beginning, 6% will be taken front end from that. So that's always good to know. That is the only charge or only expense premium that is associated with the paid up additions. 0 to 100 or a pay to 100, you can do it up to age 75. Now, here's the key about the paid up additions. Until age 73, you can continue to utilize the paid up additions, the lesser of 25 years or to age 80. So therefore, when you're building this, it's mindful to know that, you know, you have typically, if they're building it within the before age 73, that they can utilize it for 25 years or to age 80, whichever comes sooner. Minimum premium amounts, single premium is $600. The flexible is $50. Also to note on the flexible paid up additions rider, when you build this, when you complete the illustration, when it is approved, the first premium payment must be exactly like the illustration states. So therefore, if they're doing a monthly payment, it has to have the monthly payment and it's got to be paid exactly as it is in the illustration. If it's an annual payment, it has to be done as the annual payment. That payment and premium mode must be exactly as the illustration the first time. So let's say you build it out and you build it out as a monthly to pay this amount, which will go into the cost of insurance and the paid up additions rider. The first payment has to be that amount. Afterwards, then you can play with it. So therefore, if you no longer want to utilize the paid up additions for a couple of months, you can pull that back and just pay the cost of insurance. But again, you've got to really respect what that illustration is. When you're doing this, it's not for the faint of heart, because you have to make sure that everything is within the boundaries, and you've got to stay within the lines when you're coloring the illustration, because if you go outside, there could be taxable events, and that's one thing you don't want for your client. So therefore, it's always good to make sure that you stay within the boundaries of what it's doing. Now, when we get to our illustration software, we're going to talk about MEC, modified endowment contracts. When we talk about MEC, now MEC is not always bad. If you never want to take any money out from the cash value, then having it MEC doesn't matter. However, that totally defeats what we're trying to do here. So you want to make sure that you stay within the MEC guidelines. So therefore, you're going to have to make sure. And then when we do the illustration, you'll see that in the illustration software that that we do have the MEC guidelines built in, so you can actually utilize that. Now, the maximum premium that you can put into the paid up additions is a maximum of $200,000 per year and $2 million for your lifetime. Now, when we get to the illustration software, you'll see that the default on the illustration software is actually $100,000. Well, we will change that to $200,000 because our maximum is $200,000 with a $2 million lifetime. Additionally, be aware of this, is that we will adjust the paid up additions. So for the first 5 years, after the 5th year or 5th anniversary, we're going to go back and just make sure as to what how much that you have utilized into the paid up additions, and we can reset the maximum amount that you will put in there. We will do that again after the 10th anniversary and then annually after that. When we take a look at the term riders, again, as I mentioned, the term riders are very beneficial in doing this kind of sales concept because it allows you to increase the face amount by using a term rider, but limiting the premium because the cost for a term product versus whole life is less, and therefore put more funds into the paid up additions rider. We can use a 10 or a 20-year term rider. Most people will go with a 10-year. If somebody wants to really build a plan for longevity, then they may take the 20-year term rider. So therefore, they have a longer runway in order to have the life insurance that they want. Also, the term rider that we have is convertible. So therefore, if they want to convert it to permanent life insurance later on, they can do that without the evidence of insurability. So no further underwriting is done on that. Again, the eligibility regarding the 10 and 20-year term rider, the maximum coverage amount on the fully underwritten will be 12 times the base certificate. Where that comes into play is when we start playing around with the illustration software, we can designate what percentage we want of the term versus the base certificate of the participating whole life. And finally, when we talk about this, on the Advantage Plus 2, you're either going to have to do an illustration that's signed off by the client or the illustration certification form. Now, if you're just using this product and you're just doing a basic Advantage Plus 2 participating whole life, there's not a lot of bells and whistles. You're not really playing with the illustration software. Then I would tell you, just do the illustration certification form. What that allows is that rather than you having to make sure that the illustration is done absolutely perfect, when we issue it at Foresters, we're going to do the illustration for you and have it done completed. Now, back when I was in the field, when we did an illustration, I could do valued agent or valued customer and trusted agent. Now you have to make sure that you put that customer's full name in there, your full name. Some states you have to put your ID code or your agent license number in there. And so therefore, if you were doing a $200,000 illustration and you come back and now the client wants $250,000 worth of insurance, that illustration can't be used. So that's why the illustration certification form is so beneficial. However, when we are doing this, especially in the infinite banking concepts, or we're creating that concept, we are not using a cookie cutter. We are building something for that client. I'm going to tell you, make sure that you do an illustration. Make sure that you present the signed illustration of exactly what they're going to do. So there are absolutely no questions, no concerns, no issues with what's going on. So at this point, Maritza, let's just pause. I'll open it up to any questions, and then we'll go into the illustration software. Does that work for you?
Absolutely. Any questions, guys? Now's the time. No one has a single question.
I have a question. I've heard this term positive arbitrage used before with this, where I guess if you're taking a loan out at 3%, but you're earning 10 or 11%, like what does that really mean? Does that loan get repaid back by itself, or with the what does that positive arbitrage actually mean?
So Chris, what it really is saying is that you're making money by borrowing your money. So as I pointed out, is that our interest rate currently for borrowing the money is 4.5%. Yet our dividend that we've paid, not guaranteed, but the last 2 years has been 5.8. Well, 5.8 is more than 4.5. So therefore, even if you're borrowing your money, you're earning more money, or potentially earning more money on the dividend. So it's a positive arbitrage. Make sense?
I get that one is greater than the other, but does that eventually catch up to where it helps you repay your loan? Like it's kind of wiping that obligation to repay it, or is that not? Am I missing it?
You're missing it. You still have to pay. You
Right.
still have to pay it back. So,
Okay.
So do not. And I tell people, never look that. Even though you're making money on borrowing your money, do not think that that means that it's going to, wipe out the loan. It's not wiping out the loan. You still want to pay it back because that's how you want it to grow.
All right, I gotcha.
So Chris, the only time I ever advise or even talk about not paying back a loan is when people are consistently overfunding. I always talk to my clients about overfunding if the goal is to start borrowing within the first 10 years. If they want to leave it alone and, leave it alone for after for retirement or what have you. If they have that time frame, I don't even talk about it. But if I know it's something that they're going to need to borrow from for a business, for example, I can always, without fail, I always tell them to overfund, that it's absolutely necessary if you're planning on borrowing, especially a larger sum of money. So that's typically how I would stick by that.
And then on the overfunding side of it, do you run into mech areas there by how much you're allowed to overfund?
You have to be very careful with how.
Yeah,
absolutely. So you have to be very careful, and you have to take that MEC amount into consideration before anybody begins to overfund. So it's your job to make sure the client knows how much money they are allowed to overfund the policy with every year.
Understood.
And Chris, that's why on our illustration software, we actually have it where it will figure out the MEC amount and not let you cross over that amount.
Okay, so there's kind of some guardrails in there. Okay. Thank you.
You're welcome. Anybody else, you guys? So Bruce, I have a question. So is there a difference in the commission between the 100 pay and the 20 pay for the agents?
There could be, yes. I don't talk about commissions because the commissions is set already. You would have got your commission schedule, but yes, typically what you're going to see is when you're looking at this, look at first off the difference between the 20 pay and the pay to 100 and the 20 pay. As I mentioned, I typically don't even talk about the 20 pay when I'm building these because I want to make sure that I'm utilizing the best benefit for the client, which would be to pay to 100 because of the MEC rules, okay? And allowing you to fund it as best you can. But I would look at, here is what your commission will be for the pay to 100. Here is what your commission will be on the term rider, because that will be another commission, whether it be the 10 or the 20-year term rider. And then obviously the commission that you're going to get on the paid up additions rider. Now, I will just state it right out there, folks. The paid up additions rider is a substantially reduced commission rate because it's like an annuity. It's you're putting money into the bank. So that's why you've got to play with the illustration software as to how you want to maneuver it. But the mindset is really doing what is ever best for your client, but you can be mindful of the commission differences as well.
Absolutely. Is there a premium difference between the med and the non-med for the client?
Is there for which one?
Or is there a premium difference, a premium amount difference between the med and the non-med?
Well, there would be, because on the non-med, it's going to be it's a accept or decline standard rates to substandard table 4 underwriting. Where on the fully underwritten, on the med, you could get different rating classes. So you could go from, from standard plus, preferred plus, tobacco, non-tobacco, and then obviously on the substandard side.
Perfect, thank you. Anybody else have any questions, guys? Okay, we're good.
Okay, perfect. So you can see the website now, correct, Merce?
Yes.
Okay, perfect. So we're going to go in. This is where we're going to go to the illustrations. So we go into the illustration software, and we're going to illustrate by product. So once you log in, it's going to be pre-populated with your information because you're logging in with your agent code. You're going to go into the Advantage Plus 2. The state really doesn't matter as we're doing this, because every state has the same rates. Now, this is key. Product type, we want to change that to medical, because if you keep it on non-med, it will not allow you to do the flexible paid up additions rider. The percentage on the tax rate doesn't matter, because you don't know what your client's tax rate is. You're going to fill in all the information again. Remember that it is age nearest birthday. So therefore, depending on their birthday, 6 months before and after is what we're going to view them as. Tobacco or non-tobacco, you may or may not know what their rating will be. So you could say no, or if you go to yes, then you can change it accordingly. But for the most part, you're probably not going to know. I just tell people, just do it at standard. And then, say when we send it in, we can get a better rate, hopefully based on their health. Go into the death benefit and funding. Okay, now I'm going to change this. So here we have that 35-year-old. We're going with the pay to 100. The case design. Remember this, folks, because this is where you're going to be able to play with it. Going in here, typically, you're going to want to use these ones that have the non-MEC. The non-MEC solves. And the reason being is that, yes, you can do it, and it'll allow you to do whatever you want. So therefore, you could come into a situation where you're going to MEC it out. And in fact, I had a situation a few months ago where an agent came back to me and said we wouldn't allow for a certificate to be issued. And it was because it was going to MEC in the second year. And obviously that wasn't something that we were comfortable in doing. And we brought it back to the agent, and the agent had not used one of the non-MEC solves when doing it. I typically will use the permanent term blend non-MEC solve. Reason being is that that's the one that will allow you to do a little bit of perm and a little bit of term and getting the best for your client. Some will just want to do a full face solve where they just want all permanent. So, there's opportunities. And then there's the base FPUAR percentage where you can say, okay, we want to do a 60-40, because there are some disciples of the infinite banking concept that actually do profess that they will do depending on age and health, do a 70-30 or a 60-40 or a 50-50 split on the clients as to the whole life and the term. But I typically go with the perm and term. For our default, our term percentage will be 75%, meaning 75 in term, 25% on the par whole life. When we go over here to the right-hand side, this is where it figures out the solve. So, in this situation, we're putting $269 a month. Well, let's change that to 500. So we're putting 500. As you'll see here, it'll start saying calculating. And the summary values for this is that what it's going to do is on the $500, $58.89 will be for the paid up additions rider, will be for the par whole life. $840 will be for the term rider, and $432, which is the difference, will go into the paid up additions rider. Now, if I go back up here and I just go to no solve, no rider, it will now calculate. Just gonna have to take the rider off. Take the rider off. It will calculate. And now the $500 is going to buy $194 of just par whole life, no term, and $305 will go into the paid up additions rider. But again, like I said, for myself, I've always believed that it is most beneficial. And you can do the 10 or the 20 term rider depending on how they want. So in this situation, I'm going to have to go back here. Again, term and perm, it's going to calculate. So 58.89 goes into the par whole life, 840 into the term, 432 will go to the paid up additions rider. Now, paid up additions is going to be the dividend option. Again, here are the, these are the complementary riders and provisions. When we go into the riders, this is where we're going to play a little bit more. Single pay, typically, most of the times, you're not really working with a single pay. However, if somebody says, oh, I got a bonus of 20,000 or I have 20,000 that I want to dump in, this is where you'd put this amount. This is where you would change, as I mentioned, the maximum that you can put into the paid up additions rider is 200,000 per year. That's where you would put that amount. I had to change it from 100,000 to 200,000. It's not going to change any of the illustration. The term rider, we can do it for 10 years. If we wanted to do it for 20, as you're going to see, it will increase the premium because we're now adding a 20-year term rider versus the 10. So therefore, that funds will come out of the cash, what's going to the paid up additions rider. So therefore, that's why a lot of people will stick with the 10-year term rider, and that will expire after that. So we can go here to at a glance, and this is just going to be just a quick summary of what we're doing. So it was a 35-year-old male standard, put $500 a month, which is $6,000 a year. The guaranteed cash value is $49.64. Guaranteed death benefit is $222,000. Now, They do calculate what the possible dividend would be, plus what you're throwing in there on the paid up additions. And it will, notice what you, the different columns will have the different amounts as we go through the years. Over on this end is what is the amount that I am underfunding it. So I'm not taking full advantage of that 200,000 a year. And to what extreme? And then remember, after the 10th year, it goes to a portion where it will say, what is the amount? So, or after the 5th year. After the 5th year, this is what we're putting in. Is we're putting 5193 per year. For the most part, you're not going to have to worry about these columns. You can keep an eye on them, but for the most part, you're not going to worry about what's going on. And remember, after the 10th year, because we took away the 10-year term, so the premiums will fall, and along with it will be the face amount difference of the term rider falling off as well. However, the one thing that you will notice is that the cash value continues to grow, and that's really what you're building here, is for the cash value. Now, if I go back in and I don't think I can do that. This would be how you would go to reports, then create and preview reports. This will allow you to do the full illustration. And this is the illustration that you are going to print out for the client. It's also the illustration that's going to show you exactly what the amounts are. So for what you're buying is that you're paying $58.89 for $50,000 worth of participating whole life. You have $150,000 of the 10-year term rider that you're paying $88.40 for, so $67.29. The remainder goes into the paid up additions rider.
I don't see the illustration. I don't know if you pulled it up.
Yeah, no, you know what? I think what it is, because it opened, I'm going to say that it probably opened up a new window and doesn't allow, but you can, so you just go to create and preview, and that's what it'll allow for you to do. Let me go back here. Now, when we go into this, you can change the percentage amount. So if you want to do a 60%, again, now it'll be 60% term, 40% of the par whole life. As you can see, what it did was it adjusted the cost, because it's going to adjust what the face amounts are. So now you're paying $81.46 for the par whole life, $6 for the term, and $412 will go to the paid up additions rider. So again, it's just ways that you can play with this illustration software. In fact, I tell people, just go into it and start playing with it, because you're going to see for different solves, it's going to give you different outcomes as to what you want to do and how you want to build it for your client. Now, if I change this to 95%, all of a sudden I get the red X. Typically, why? Because I'm trying to do something that's going to either make it a mech, or it's going to be outside of the guidelines. If I go back to the 92%, which it allows, is that a lot of it, whether I go to the 92 or the 90, it probably will give you the exact same scenario for the most part, because you're going to be in the same ballpark as to what you're allowed to purchase under the MEC guidelines. So, but again, as I inform people, you're just best off to just play around with it, and see, see what opportunities you have. Trying to think here what else we would want to do. So if the person said, hey, I do have some money around, I want to throw 20,000 in. So now you're going to throw the 20,000 in. So that first payment is going to be 20,500. Remember, as I noted, that first payment has to be exactly as the illustration was, of which, the 20,000 is going to go into the paid up additions rider, 78 will go to the par whole life, 34 to the term rider, and then out of the $500, $386 will go into the paid up additions rider. When we go to at a glance, you're going to see that because you put in the extra 20,000, here's the cash value, guaranteed death benefit. Again, as you can see, after the 10 years, the death benefit decreases. But the one thing I always am surprised about is how the cash value continues to grow. Now, you can see the difference between what the guaranteed rate is as to what the expected rate is. But there's pretty healthy opportunity within it. So, Maritza, is there anything else you need me to show?
Yes, if you don't mind, can you show us how to offset a premium? For example, let's just say a client has a lump sum amount, a single payment PUA, and they want to pay it for 10 years because they're going to retire in 10 years. So can you show us how they would do that in the illustration, just so we can present it to the client?
Okay, so in the illustration here, this is where you're going to put in the single pay. So what do you want to do?
So I want to offset it. For example, if the client only wants to pay, let's just say the client has $100 grand, or $10,000, and he's going to do a single payment PUA, right? He's not going to overfund it with anything else. And his premium is $1,000 a month. Okay. But he only wants to pay for 10 years because he's going to retire in year 10 or,
Yep.
What happens. I want to make sure that he sees in the illustration that it's only going to be paid for 10 years. How do we do that?
Okay. So we're putting 10,000 in. Paying $1,000 a month.
Sure.
Now, right here, reduce paid up. Yes. Beginning in year 11. Okay. So now
Perfect.
when we go, we're going to show that he put the 22,000, which is $1,000 a month plus an additional 10,000 in at the very beginning. He's paying $1,000 a month for 10 years, and then that's it. He's shutting it down. And here's how the growth is going to be. Make sense?
Absolutely.
So there's
Does
great.
anybody have any questions? Sorry.
No. Go ahead.
Does anybody have questions about this, you guys?
No, this makes total sense on the 10-year. It actually makes a good illustration, but I wanted to ask, I still want to understand a little bit on the difference between withdrawing money or borrowing money, because it almost seems like it's the same, but I might be misunderstanding something.
So the way I talk about it is I talk about it being the same, whether you're taking a loan or a withdrawal. The thing is, with a withdrawal, it's, you know, that's where it's, you're just taking money out with no idea of paying it back. But I don't even talk about it being a withdrawal. I don't even talk about that. I just talk about loans, and that I always want to talk about them paying it back. Because here's the thing is that, so I'll put this into a scenario, into a plan. So you own a liquor store and we're having this meeting, and now you're inviting me over to your house after the event, and we're having a get together. And let's say I drink Jack Daniels. You don't have any Jack Daniels in your house. So on your way home, you stop by your liquor store and you get a bottle of Jack Daniels. Are you going to pay for that bottle of Jack Daniels?
If you're the owner of the store?
Correct.
No.
So Isabel,
Or you might, I mean, I guess.
so Isabel,
Yes.
if you don't pay yourself for that bottle, you're stealing from yourself.
Yes, you're right.
So and no, but and this is what happens is that, and so therefore it's important to pay yourself back, because what you're really trying to do is you're trying to continue to build the cash value up. If you had taken the money from a bank, you're going to pay the bank back. Why not pay? Why not you? And we talk about this, you're the bank. Why not pay yourself back with interest, which makes it grow bigger and bigger?
Right. But I asked the question because there are going to be people that, especially if it's the terminology of infinite banking or it build your own bank and this is your money, there are those people that are going to say, well, why can't I just withdraw my money? You know what I mean? Like, why can't I just take my money if it's my money, right? So that's why I want to be clear on the difference between a withdrawal or to, you know, borrow your money and having to pay it back. And what happens if they say, I'm going to borrow the money and then they don't pay it back? How does that work?
Well,
That's
so if they borrow their money and they don't pay it back, when they pass, it's the whatever is outstanding is deducted from the death benefit, from the cash payout. Now, the thing is that handling it as you stated is that it really defeats the purpose of what you're trying to build for them.
Right.
And you know, almost Isabel, say to them, well, if I built you a house, do you only want one door or one window? Like, you want more opportunities to make things the way that you do what works for you.
Right.
And you are correct. There are going to be people that are going to say, well, it's my money, I can take it. But again, that just defeats the purpose. Maritza, what would you say in those scenarios?
So I always tell people, if they are not overfunding this policy, they are only doing the premium and a one-time lump sum. So there's the difference between a withdrawal and a borrowing amount is if you're not overfunding, you're withdrawing. So essentially what that can cause is what it's going to cause rather is you're liquidating your assets basically. So it's like you're taking your own money, like you said, and you're not paying it back. What's going to happen is you're going to end up with income taxes because you're taking gains without paying it back. That's no longer a loan. But if you're overfunding, it makes it a little bit easier to be able to borrow because again, you're overfunding, and what ends up happening is you're creating more and more dividend interest, if that makes sense. So that's how I explain it.
And Isabel, if you remember at the very beginning, I talked about tax advantage distribution opportunities. If you're just taking the money out because you think that it's yours, you've now defeated that tax advantage. So you're actually feeding it back to the government. And I don't know about you, but I don't know if I like to give any more money to the government and to attorneys than I have to.
Right.
So
I don't. I know I don't. But I have
Right.
to ask the questions, obviously, to have a clarification because I come from obviously learning IUL and how they're so big on like you can borrow or you can withdraw. If you borrow, you keep the cash value that you have in there and it continues to grow without skipping a beat because you're just borrowing a certain amount. But it almost seems like with a participating whole life that you're borrowing from the amount that you have the cash value. So it does reduce the amount that you have available, in other words.
Mhm.
So when you're borrowing from a participating whole life policy, you're not borrowing from the cash value. You're actually borrowing from the insurance company. Okay. So if you don't pay it back, then what ends up happening is it ends up either two things happen. Again, you're either liquidating your assets or what happens is it's going to reduce your cash value in general because it's going to pay itself back from the death benefit. Okay. So, I mean,
Right.
yeah, it's either liquidating or borrowing. Liquidating is going to be withdrawing as opposed to borrowing from yourself.
And if a client decides to withdraw, does that I'm assuming it reduces the death benefit as well?
So it depends.
does
It
it keep
depends
the same?
again. So it depends. It depends on the amount, one, and it depends if they're overfunding. If somebody is consistently adding funds to their whole life policy, it's going to make a difference. But yes, I mean it's on a case by case scenario, honestly, and and it's on the amount as well. Some people borrow very little; they don't, but some people want to pull the full amount of cash value, which is a red flag. I mean, you have to be
Right.
very careful. Like, that's why I say you have to be very careful on how much you're overfunding and how much you're borrowing with this. So it's based on what the client's goal is. So for a business owner, we have to structure it very carefully so that they are able to borrow, and overfund at the same time. So it doesn't create a mess, if that makes sense.
Tax mech and all that stuff. Okay. So I'm just I don't want to confuse anyone. I just want to understand it myself. Okay. Thank you.
Okay. And it's a good question.
Any other
Bruce, anything
questions?
else?
Yeah, I dropped one in chat, but when you were on that paid up additions writer page, one of the little fields there that we didn't fill in was the 1035 exchange on there, because we put in a non-qualifying amount, just like if somebody has that money in their bank, but then 1035 exchange amount, like what does that mean, and what would qualify for?
Okay, so Chris, that's a great question because here's the deal. You're thinking 1035, you're maybe taking an annuity into a life. No. Because it has to be like for like. So therefore, it would be, let's say you've got a UL that has cash value, or you've got another whole life that has cash value. Therefore, you're maybe replacing that, and you want to take that money and put it in. So it would be from a life insurance product to another life insurance product. I do not, and I don't know how Maritza feels, but I do not propose that people go to their 401ks or their or any of their investments, annuities, and try to move the money, because that will make it a taxable event.
Yeah, that was what I was confused about. I know there's some people that do strategic rollouts, but they wouldn't be doing like their whole 401k at a time, where they'd owe a crap ton of money.
Correct. Yeah, and to me, it's like, you know, we're not at that level to do it, but it would be if somebody's saying that they're going to replace their existing par whole life, or their existing, you know, whole life that has cash value, or their universal life that has cash accumulation, and they want to throw that money and roll it into this.
I got it.
Anything else, you guys? Nothing? All right. Well, Mr. Bruce, I appreciate you as always. This was very, very helpful, beneficial to these guys. Yeah, if anybody has any questions, or if anybody needs help structuring this, feel free to reach out to myself or Bruce. Everybody has Bruce's number. And yeah, so nobody else has questions.
Long weekend.
We're good to go. All right. Well, you guys enjoy your weekend, and I will see you on Monday. Okay.
Thank you.
Y'all have a good. Bye-bye.
Bye.
Thanks a lot, Bruce.
Thank you.
See you soon.